Let us know about US-China trade war. The ongoing US-China trade war, often referred as to Tariff War 2.0, has significantly impacted global markets, including India. Here is a straightforward breakdown of what's happening and how it's affecting Indian investors. What's happening between the US and China? In early 2025, the US imposed a sweeping 125% tariff on all Chinese imports. China retailed with tariffs up to 84% on US goods, targeting sectors like energy, agriculture, and machinery. This escalation is reminiscent of the 2018-2020 trade tension, but the unfolding more rapidly and broad this time. Impact on Indian stock market. $180 billion in market value was wiped out from Indian stock within 2 days of the tariff announcement. Indices like the Nifty 50 and BSE Sensex expired significantly declines, with the Nifty dropping 743 points and the Sensex over 2,200 points in a single day. Sectors such as metal, IT, and financial services were among the hardest hit. Sector-specific effects. Metals. Companies like Tata Steel and Hindalco faced pressure due to global demand uncertainties. IT services. Firms such as Infosys and TCS saw decline amid concerns over reduced US and China spending. Financials. Banks like SDFC and Kotak Mahindra experienced volatile linked to foreign investment outflows. India's strategic response. The Indian government is exploring opportunities to increase export in sectors like textile, footwear, and food to the US, aiming to fill gaps left by Chinese goods. A 90-day pause in reciprocal tariffs provide India exports a window to adjust the potential gain market. However, there is a caution as Chinese goods may flood non-US market, intensifying competing for Indian products. What should Indian investors consider? Stay informed. Monitor global trade development as they can have swipe impact on market. Diversify investments. Spread investment across sectors to migrate risk associated with special industries. Focus on domestic growth. Sectors driven by domestic consumption may offer more stability amid global trade uncertainties. What triggered it in 2025? US President Joe Biden imposed 125% tariff on the Chinese imports includes electric vehicles, solar panels, semiconductors, steel and aluminum, batteries. The reason? The US accused China of flooding global market with cheap products, unfair subsidies to Chinese companies, volatile trade agreements. China's response. China hit back with up to 84% tariffs on US imports targeting energy like LNG and oil, food and agriculture goods like soybean, corn, and high-tech machinery. This has caused global trade disputes and economic uncertainty, a full-scale tariff war. Why this affect India? Even if we are not involved, India is not a direct participant, but global market shift affect us due to. First one, stock market volatility. India indices like Sensex and Nifty 50 dropped sharply, over 14 lakh crore. That means $180 billion was wiped out in 2 days. IT, metals, auto, and bank stocks were hit the hardest. Foreign institutional investors, which means FIIs. Foreign investors are pulling out money from emerging markets like India due to risk aversion. This causes INR to weaken, the market to dip. Third one, trade redirection, opportunity and threat. Chinese goods may be the diverted to the Indian and flood out market, hurting local manufacturer. But India also has a chance to replace China as an export supplier to US in textile, electronics, pharma, and auto parts. How India could benefit if we play it right. New trade deals. India is talking to the US to boost export of make in India goods. Investors' interest. Some US firm may shift supply chain to India away from China. Startup growth. Focus on EVs, electronics and clean energy could rise. What should Indian investors do? Diversify your portfolio. Don't bet only on global financing sector. Include domestic demand sectors like FMCG, banks, and telecom. Focus on export lead winners. Keep an eye on companies that may gain from US China dispute like textile, pharma, defense, manufacturing. Stay calm. Invest in long term. Volatility is short term. India's growth story remains strong, especially with global supply chain shift. Let's dive into sector by sector impact of the US China trade war 2.0 and which India stock to watch, all in simple terms for smart investing. First one is IT sector, technology and software, which impact is mostly negative for the short term. Global companies, especially in US and China, may cut back on IT spending. Export heavy companies like Infosys and TCS may see temporary pressure. Stocks to watch. HCL Technology has diversified contracts and domestic project. TCS and Infosys solid long-term bets but may see near-term volatility. Second one is pharma sector, and pharma sector impact mixed to positive. India is the big exporter of generic drugs. If the US cut medical imports from China, India pharmacy may step in. Stocks to watch in pharma sector: Sun Pharma, Cipla, Lupin, Dr. Reddy's Lab, especially strong in the US market. Third one is metals and mining. Impact is very negative. Global steel, aluminum prices are falling due to overcapacity from China. Indian companies may face cheap Chinese competition in third party country. Stock to watch: Tata Steel, JSW Steel, Hindalco. Not great for short term but may bounce back if India introduces anti dumping protections. And the fourth one is textile and apparel. The impact is very positive. We have big opportunity over here. US may impose more from India. If it reduces depends on Chinese textile. Stocks to watch in textiles. Wellpus India, which means home and textiles. Arvind Limited in denim and fashion. KPR Mill, Page Industries, that is in innerwear and activewear. And the fifth one is electronic and auto components. Impact is positive if India boosts made in India. Supply chain shift from China to India in the medium term. Electric vehicle segment may see growth with US support. Stock to watch: Bharat Electronics, BEL, Defense Electronic. The second one is Dixon Technology. Dixon Technology is in mobile and consumer electronic assembly. And third one is Sona BLW and Motherson Sumi, which is in auto components. And the sixth one, financial sector. Impact is volatile. FII means foreign institutional investors are selling, which means pressure is creating on bank and NCFCs. But domestic bank are safe for long-term growth. Stock to watch: SDFC Bank, ICICI Bank, Kotak Mahindra Bank. Strong fundamentals. Avoid smaller NBFCs for now. because marketed down. The seventh one is FMCG, fast moving consumer goods. Impact, safe and defensive, doesn't depend on global trade. Domestic consumption continue even in global tumor. Stocks to watch in FMCG sector. HUL, which means Hindustan Unilever, Nestle India, Dabur, Marico, ITC.